Hi everyone. Welcome everybody to attend this webinar hosted by Raffles Family Office. We will probably start soon and just a few minutes. Currently we have myself, Ms. Tina Chan. I'm the head of strategic partnerships of Raffles Family Office. And we also have Mr. Ray Tam, Mr. Anson Law, and Mr. Guosen Lee with us. Let's just wait for a few minutes, and maybe when we are waiting, I can quickly go through a few house rules. Just a second. So again, this is a webinar, about the Hong Kong Family Office presenting, new fund structure, new opportunities, showing that Family Office as early adopters of the new Hong Kong Limited Partnership Fund regime. So in this webinar, it will be, the duration will be an hour, including Q&A at last. So do submit your questions in the Q&A section. It can be anonymous, and we will have time after the panel discussion to answer some questions live. For questions unanswered, don't worry, you will receive a reply from us before the end of the week. So by default, your microphone is muted, and just so you know, the webinar will be recorded. Do know that all the contents we made, the intellectual property of Raffles Family Office and the organization involved. So if you want to quote anything from us, do check with us ahead. And so far, I think most of the participants are in. Maybe I will just stop the screen sharing for now so that I can introduce the gentleman next to me. So again, I'm Tina. Today I'll be the moderator for our panel today. And our panel again is about how Hong Kong Family Office introduces new fund structure, new opportunities for everyone. And so right next to me, we have Mr. Ray Tam. He is our co-founder of Raffles Family Office, and he's also will be sharing, a lot of insights from, multi-family office, family perspective. How do we see this new fund structure will be helping our clients? And next to Ray, we have Mr. Anson Law. Thank you so much. He is the market development division from Hong Kong MA, Hong Kong Monetary Authority. And right next to Anson, we have Mr. Guosen Lee. I'll call you Guos. He's the partner of King & Wood Mallesons, one of our closest legal partner for doing these fund structures. So again, welcome everybody. We'll just get the whole thing started. So again, to welcome everyone again, in the next hour, we will be discussing the topic on, how this whole Hong Kong New Limited Partnership Fund audience that has just recently commenced last week, August 31st. And from what I understand, on the first day, we have already received 11 cases registered for this new fund. And to me, it's actually quite a good number. For Raffles, we are actually very honored to have, Anson and Guosen here, because Anson is actually the one who initiated this, fund. And I think from him later on, his introduction and discussion, you will find out a lot of intention and reason why behind of this fund setup. So let's not wait, but I will just pass the ball to Ray to give a very quick intro of Family Office, about Raffles and the trends that we're seeing, and then I will jump back into let Anson and Guosen to present that part. Hold on a second. I will just share the screen. Okay. So again, Mr. Ray Tam is our managing partner and co-founder of Family Office.
Right. Thank you, Tina, and of course, thank you, Anson and God, to come to our office for this webinar. And before I share the trends or what we see from the market right now, even for the family office industry, here's some background of Raffles. So we are a multi-family office and an independent asset manager in Asia. So right now we have 4 different locations providing service to the high net worth individuals and families in Hong Kong, Singapore, Taipei, and Shanghai. Other than IAM, we also provide the family office solutions, which I think this is the key part that we're going to mention today. It's about how we setting up structures, frameworks for the family, for their family governance, and also all their tax purposes. And this is where we put the most. And on the other hand, we also have the wealth planning and the legacy planning advisory service, and also the consultancy service to our families. So before that, here's some explanation, or some of the marketplace or the industry we always ask us a question about what exactly multifamilies do to serve the family. So in terms of the asset part, what we call the IAM here, or EAM, external asset manager, the key point here is that it's always a triangle relationship, we call. So basically, client or the custodian banks, they always have the safekeeping of the asset for the family in terms of the company account, or even personal account, or even the trust. This is where the asset mostly custodize in. And for Raffles, that we would provide the independent asset management services to them. So we are the one who actually execute the trade order to the banks on behalf of the clients. In other words, that we always act as a gatekeeper, that we safeguard the asset for the client as well. So right now we are working closely with 23 different private banks, including we are able to book their client asset into 5 different jurisdictions: Hong Kong, Singapore, Taiwan, Switzerland. We would say is actually Zurich, and also Liechtenstein at the moment. So from here, here's some figures that we see from, of course, from our own group, and at the same time from the market. And when we talk about the fund structure, and as I mentioned about the family solutions, the first thing we always think of is like, how do the asset be located or put in the framework that makes sense for the whole family. So here's the first part that we always came across, is about the wealth transfer. So when we talk about the wealth transfer, succession planning, when first generation passed to second generation. So estimately from the report in 2019, they estimate at $68 trillion to be passed to the next generation in the next two decades. If you see the number, yeah, it's a big number, but just give you an insight of that. So if you talk about like Alibaba Group right now, capital size is about $700 billion, then it's actually 100 times of Alibaba size right now to be passed in the next decades. So and also for if you specifically into the next 2 or 20 or like 30 years, especially for the baby boomers, which is actually happened in the 1940s to 1960s, where the first generation, or even those billionaires that they're reaching the age of 60s, so that we see a large demand of passing asset to their next generation in that sense. And if we look into specifically in Asia, there's actually $15 trillion, which is also quite a big amount of that. And obviously what we see from here, Asia is actually mostly their first generation right now. So the demand here is huge. On top of the transfer of the asset, the other main drive we see from here is the growing demand. What we see the growing demand is when the new billionaire or new wealth was created. If you see the report from even UBS, from last year, that 60% of the clients actually contributing the new growth, as we call it, the wealth from the whole world. And typically even from China, there are 2 new billionaires every week in China to be born. So what we see from here is basically, first of all, they're quite young. I would see that the new wealth owners, that they trend to be, unicorn tycoons, or they're actually entering their early 40s or not late 30s or even like late 20s. So the key point here is the increasing demand of the VC and the PE projects, or the appetite that they're going into that kind of investment has grown rapidly in the decades. And so here's the reason we see from here is, and when you talk about the first generation, mostly you see some traditional investment going on, but for the second generation, for the new type of investment they're looking for, first of all, the risk appetite is different. So they're risk taker. So they would rather go into something new, something different from their own families or their first generation. So this is where the younger generation are starting to manage the family wealth. Secondly, for the diversification, traditional market, yes, of course we still really into it, fixed income, capital market, equities, but at the same time they would rather do something lower correlation to the traditional asset class. And lastly, I think it's about the return or expected, IRR that they're looking into. So basically, for younger generation, they would prefer to diversify. They would prefer to look into by themselves. And on the other hand, I think this is a great demand of setting up proper structure for them. Is they would sometimes would like to share with even their peers or their other families or family members that they would like to invest together with them. So if you ask me, private equity, yes, you see the percentage here from the reports. It's actually showing that 69% of the return that expected from the portfolio nowadays is actually focusing on the PE side. So in terms of resources, in terms of the times that they put it into that, it's relatively high right now. And here, I think we can actually show some figures that what we see from the first generation to the second or even third generation is in the first generation. I mean, overall, I would say traditional, banking industry or well, asset managers point of view, fixed income is always the part that we would always talk about. Equity, just to add up on the 50% of them. Alternative by then is actually less than 10% or even less. The rest of it is a cash position. So basically, they're the first generation or the traditional investor that they would mostly they would go into the traditional investment like even real estate or even the stable income. But when you see the pie chart here is going to the second or third generation, as I said, risk taker. So they lean to put heavier on the PE or VC side. So they would looking for the club deals, even the co-investment rights amongst their peers. So this is where we think that a better structure is very important for the families or the investor to do. So here is from Raffles' point of view, what we do to help the family out here is for different structure that we use for the single family or for the fundraising. The key point here is the good thing here is that first of all, you have to have an investment consolidation. So it's put it into better structure rather than putting into different pieces or different projects. At the same time, when you talk about succession planning, on the top level, if you add up a trust, it's easier to pass on the current investment to the next generation without setting them in a difficult market situation, or even when the second generation take over, or even third generation take over, they do not have the expertise or the ability to control that. So again, a structure could help them out. And also, I think what we can add on for them is the professional investment management, also the reporting and analysis, which help them to do the fundraising at the same time to share to their peers. So it's more like the independent view for them to set up the structure. And here's a few things that few structure that we use the most right now, and Cayman structure, which Barrel or standalone one. Also the Singapore BCC as well, but most of them they're just like a mini family office, and also for the investment governance. So we are very very happy to have the Hong Kong LPF coming up right now, so that I would love to see what the view from Anson and Gauze as well, so that we can add on more to our multi-family office structure in the future.
Thank you, Ray. I think Ray has given a very clear dynamic or picture of why we think that the use of fund structure would help our clients. And like I mentioned before, we have Mr. Ensign Law here. He's from the Hong Kong MA Market Development Division. And based on my previous chit chat with Ensign before, I know that actually he is coming from compliance background. He used to be on the buy side, involved in private equities, real estate deals. So his own experience actually given his team or himself a clear picture. I think wearing a hat as a user, knowing what is good for the Hong Kong fund regime, right? And then per my understanding, he actually did a lot of research, on different fund structure, especially when we often compare as an asset manager. Being very direct, we often compare Hong Kong, Singapore, and even the Cayman fund structure where everybody is very aware and getting used to it. So do share with me and our audience that why did you start this and what is the basic thing about this structure?
Yeah, sure. Thank you, Tina. So let us put the slides on.
Yep.
So to start with, actually, we started this project some years ago. Thanks for the introduction. When I moved from the compliance side to the market development team. So at the time, we were looking at a lot of PE funds active in Hong Kong, because right now Hong Kong is a hub, obviously, for PE and VC investments. In terms of AUM, we have about 160 billion US dollars managed in Hong Kong. So it's quite a decent sum. It's trading after the mainland China. And then after mainland China, we are largest in Asia. So we are way ahead of other, financial centers in Asia. But the thing is, when we looked at the market, obviously most, if not all, of the funds back then were structured as offshore funds, meaning that they do encounter a lot of difficulties in terms of their operation. So if you really look at these charts, this is a typical offshore fund structure, which I guess most of the audience will be very familiar with. At the time, we see there are a few major issues. So if you operate under this model, unless you have, like Raffles, you have a proper SEC license, you will be subjecting yourself to a decent level of regulatory and compliance risk. And regardless of whether you have a license or not, you're also subjecting yourself, your operation, to a decent level of tax exposure risk. So in order to mitigate these risks, your advisors would normally advise you to be vigilant and to make occasional travel outside Hong Kong for certain matters. For instance, board meetings, execution of contract, etc. And that really introduced a lot of hiccups in terms of operation. So this was the starting point. And we look at this, in a much closer distance, we see some other trends coming. So as I said, we have a background from so I personally, before joining the compliance team, I was with the Exchange Traded Investment Office. I was back then responsible for running the Europe private equity and real estate investment portfolio for PE and real estate. So at the time, we did talk to a lot of people, including GPs, including investors in Europe, and we're seeing a trend coming, which is spearheaded by the OECD. It's called the base erosion and profit shifting. So in a nutshell, there are 15 actions therein, and action 5, harmful tax practice. Action 6, prevention of treaty shopping, would irrevocably limit the room for operation of PE, VC funds, as well as similar investment structures. For instance, the family office space, they will be impacted upon severely and irreversibly. In high-level terms, fund structures, particularly for offshore structures, they have a structure somewhere, maybe in the Cayman Islands, maybe in BVI, or other places, Jersey, Guernsey in the past. And then they invest in a certain jurisdiction, or maybe in Southeast Asia, in Malaysia, or in the mainland. And then they have some of their team or some of their activities in a financial center, for instance, Hong Kong. So this will be attacked by OECD in the coming years. And the risk is that today it may be okay. Certain years down the road, when you try to exit your investment, you may find that the expected return could not be met because you could not tap into the DTA network because of OECD action. So this is the high-level summary of the threat that we are talking about. And the second trend that we saw is actually happening in Europe, is the regulatory trend, which really drove a lot of offshore funds from offshore to onshore. So we've seen this trend from happening in the US, in Europe, and we do expect this to spill over to Asia sometime. So when I was running the Europe investment portfolio, when we talked to investors, many of them back then, which was, I was talking about 5-6 years ago, they were already refraining from investing into structures which are offshore. Some of them categorically say that, well, Cayman Island structure, no, thank you, we cannot do. So this is really the important thing to know. And the last thing, which is very down to earth, is about costs. Arising from the first trend and the second trend, as you have seen last year to now, there are 3 rounds of tightening in terms of substantial activity requirements for certain offshore jurisdictions, meaning that you need to hire people in those offshore jurisdictions, meaning that you need to register with the authority and be subject to additional layers of regulatory compliance requirements, giving rise to additional costs. And that's why when we designed this regime, we have in mind to help the industries to solve all these problems, be it on the practical side, you have to travel from time to time, or in response to these trends that I've talked about. So the new fund vehicle or the new fund platform at large that we're referring to actually comprise of 3 important building blocks in the design. Now, the first thing is the fund level tax exemption, which has already been implemented starting April last year. So right now, if you operate an investment structure, whether you have an investment manager license or not, whether you operate in Hong Kong or you have a CMC outside Hong Kong, you are subject to the same treatment whereby you can enjoy a full fund level tax exemption in Hong Kong. And I'll talk about this in a bit more detail in a moment. The second building block is the Limited Partnership Fund Ordinance, which came into effect, as Tina has said, on the 31st of August. And on the first day, we have received already 11 applications. And I can share a bit later on what market response we have got so far. And this is the second building block. It's a vehicle akin to the Cayman ELP. And when we tried to design this, the starting point, as I said, was we had in mind funds. But then as we go along, we find out that this vehicle that we have made is so flexible that it can cater for other uses. At the same time, we're now talking to, apart from VC fund, PE funds, we're also talking to infrastructure funds, tech funds, healthcare funds, as well as family office, banks, insurance sector. So you name it. It's really the whole financial market value chain that can use this vehicle. And the third bit is a carry interest tax concessionary treatment announced by the Financial Secretary earlier this year. So as I said, when we designed the whole blueprint, we had in mind a very important overriding principle of market friendliness. I'll give you a few examples. Now, when we talk about LPF, so basically we need a GP, an IM, and 1 LP to start with. And as Dawson, the legal expert, will talk about the details of the legal requirements. I'm not going to go into detail, but I just want to share with the audience that when we design this, what we mean by being as market friendly as possible is that the starting position of the policy is to bring more business into Hong Kong. So at the very beginning, it was very natural for us to think that, well, the GP, we want them in Hong Kong. So on day one, we wanted the GP to be a Hong Kong incorporated company. And at the time, we also noted that for offshore funds, if you have a Cayman limited partnership, it's very likely that you have a Cayman GP as well. And that's why we want a Hong Kong GP as well. But when the proposal developed, we relaxed this to cater for different operational models. So right now, we can, you can see from this chart, the GP is essentially you can have different entities to be the GP. And for IM as well, at the very beginning, we were thinking about, mandating under the LPF ordinance that the IMs must get a license from SFC. But then later, we also relaxed this to cater for different operational models. But of course, if you have a licensed IM, that would mean that you can, get more additional goodies that I can talk about. But still, we are relaxing all these in order to not to exclude any existing player from the future Hong Kong platform. So the LPF, as I said, when we designed this, we had in mind at the outset for it to be used as a main fund or a project fund, just like what this diagram is showing you. And it is also possible for this vehicle to be a feeder structure. And when we talk about feeder structure, because we have been aggressively promoting this, and a few weeks ago, I was approached by COCO by some folks in the US operating a fund which is entirely domestic, investing in the US market, but they do have a few investors from Asia. And they have called me and we've had a good discussion. And the conclusion, interestingly, was that they have been using an offshore feeder structure and they thought it's commercially viable and indeed quite attractive for them to use this flexible Hong Kong vehicle to replace the offshore feeder structure that they have been using for their funds 1 and 2. So from the fund 3 onwards, it's likely that they will move to our structure. And so this structure is flexible and they can also be used as a co-investment vehicle. And I also like to share another discussion we have been having with a local fund which focuses on investment in the Greater Bay Area. So it's already an established fund with a decent AUM. They already have a fund, and they are from time to time starting, new co-investment or project vehicles. And they are now contemplating, under their main fund, they can set up a lot of these LPF vehicles to invest in different projects. So the point here is that if you already have a Cayman or other jurisdiction vehicle there, it's not exclusive, right? That you can't set up, LPF underneath, and this is totally doable, and it's cost saving, it's convenient as well. So this chart touches on a few key features of the limited partnership fund vehicle, and our legal expert Garth will be talking into detail about this. So we'll leave the technical discussion for him. And this, as I said, this vehicle, when we designed, we looked at a lot of other different structures. So what we did was we referenced what Cayman Islands has to offer, what Singapore structure has been doing, Luxembourg, Australia, UK, as well as other jurisdictions, as well as Delaware. So we basically revealed what were the good features that they offer in their model, and we kind of copy them all in. So if you compare us vis-a-vis any other particular jurisdiction's regime, I would bet, with high confidence that if you compare us head-on with any one of them or other, common regimes out there, you'll find Hong Kong's regime much more flexible. Yes, we started late, but the good thing about it is that we can reference to what works and what doesn't. So these are the safe harbor lists. So we offer robust protection of limited liability of our investors. This is the commercial contractual flexibility that we offer, and it's also unparalleled amongst different jurisdictions. So these Garth will be talking in detail about. So I'll touch a bit about our tax regime. So as I mentioned, the first building block is a fund level full tax exemption. So in order to qualify for the Hong Kong fund level exemption, you need to first be a fund. But of course, the circumstances would vary from case to case. And for this, I highly recommend you to seek detailed tax advice or professional advice from, from your partner, Ruffles, or from a legal advisor, because this do require some professional knowledge to do it right. And the next thing is that, well, as I mentioned, if you've got a licensed fund manager, in the ordinance, in the IRO, we call it specified persons. So if you've got a licensed manager to manage your investment, congratulations, you do not need to fulfill what we call the qualifying fund condition, which essentially imposes on the number of investors you have and how you spread the holding interest among them. So if you've got a licensed manager, you need not worry about that. And subject to fulfillment of the requirements I mentioned, then you will be entitled to the full level fund exemption to a very broad list of investable assets as listed in Schedule 16C of the Inland Revenue Ordinance, which essentially covers everything a normal hedge fund will do, and also covers what a normal, private equity type fund or VC type fund will do. So essentially, you can invest in private equity, private companies, infrastructure, real estate outside Hong Kong, liquid strategy, etc. So this gives you a sense of how the exemptions work if you invest in a private company. And when we designed this, we actually made reference to a lot of industry transaction data. If you invest in a private investment, the overarching policy is that we cannot support short-term investment in Hong Kong immovable property. And this is something which is very important in terms of policy making. We do not support speculation of local property. But other than that, we are very liberal. So in terms of holding in private companies, if you hold more than 2 years, well, it's okay. Congratulations, you get a full fund level exemption. If you fail to hold, if you hold it only for 1 year, but then you invest in a small stake, less than 50% of that private company, you are still entitled to, to the full fund level exemption. And failing all these, you can still go through the short-term asset test, which is slightly more detailed, which we do not have time to cover here. But I can say that, well, when we look at the actual industry transaction data, the first two conditions already get past, over 95 and close to 100% of, the PE type transactions that we see in the market. So I can say that this fund exemption is highly operable. And so we have covered this in terms of fund level, the UFR, Unified Fund Level Exemption. And in Hong Kong, we have a wide tax treaty network. I just make 2 points here. Now, the mainland China and Hong Kong DTA, as many of you would know, offers the best DTA terms as compared to other mainland, counterparty DTAs. And Hong Kong, in APAC, 39% of deal flow is from the mainland China. The second point I would like to make is that India is the second largest pie for APAC deals. And with the Indian treaty renegotiation with other parties, other countries, and our, Hong Kong's new treaty signed with India 2 years ago, we actually also possess best-in-class terms with India. So if we add up 39% for mainland and 20-odd% for India, you actually arrive at, 2/3 of the APAC counterparts, where Hong Kong's DTA network offers the best DTA terms. So this is not to mention that we already cover about 90% of the deal flows in APAC. So if you are minded to invest in APAC, Hong Kong would be a natural place of choice of your vehicle as well as your place of operation. So that's very important in terms of DTA. The last thing I want to cover is that at the moment, we are working on tax exemption for carried interest. So for those operating a fund or a multi-family office, the good news is that we are hoping to get this legislative proposal into the LegCo as soon as possible, and definitely within this LegCo term, we hope to get it passed. And the target that we want to achieve is that with retrospective effect starting from April 2020, we want to give a very competitive tax treatment of the carried interest distribution of funds that operate in Hong Kong. So with that, I'll stop here and I'll be happy to take any questions later that the audience may have. So may I pass on the time to back to Tina?
Yes, sure. Thank you very much, Anson, for your very detailed explanation. And later on, we will have some live case discussion, which I think a lot of the attendees here, they are like, asset manager, family office, and professional parties. I'm sure you guys will be interested too. So do stay with us for a little longer. And the next, we have like Gausen here. As I mentioned before, even myself, I am exploring a few cases with Gausen about what we can do for our clients in a way that, like we mentioned before, in the past, the trend is that we do Cayman SBC structure, Singapore VCC structure, but then they are umbrella fund. They are segregated portfolio. So the Hong Kong LPGP structure is actually very different in terms of function and maybe like the benefits that Anson mentioned, maybe costing as well. And I think from the audience here, they will be very interested to know about the legal structure. When should we use a SPC? When should we use a LPGP? And also costing. Those are the good things that I think as a expert like you, you've been doing a lot of like prominent real estate deals, PE deals, VC deals. So please do share with us about the structure.
Thanks.
Yep.
Thanks, Tina. Thanks as well, Anson, for going to that policy rationale on the Hong Kong LPF. Just like, before I get into my slides, I think from a very personal point of view, when I first came to Hong Kong, I was actually based in London previously. In the UK back then, a lot of people used the English limited partnership model, which was English limited partnership as the fund vehicle of choice. And as of course, the Hong Kong Limited Partnership Ordinance is largely based on the English Limited Partnership Act. So when I moved to Hong Kong 8 years ago, I did find it quite odd that that we didn't use the Hong Kong Limited Partnership model, just like how the UK used the English Limited Partnership model. So especially as you mentioned, there's 160 billion AUM in Hong Kong itself. It just seemed odd that all the money had to be managed, like 24 hours away in Cayman. So I always found that slightly jarring, I guess. And coming to Hong Kong about 8 years ago, when we got a lot of inquiries from new fund managers, completely new in this space and want to set up a fund. One of the questions they always ask us is why we do Cayman? Why it's not even in the same time zone. So it was always quite it was quite an interesting education for both parts, for us to tell them always historical. Historical, so US firms came to Asia, so that's why we relied on Cayman, because that's how the model has always been, so if it ain't broke, don't fix it. So I think that is just how it's just progressed to be we just use Cayman. I can't actually think of any other logical reason why we use Cayman really, other than just investor familiarity. And if it ain't broke, don't fix it. So anyway, that was good to have the context behind it, and it's very encouraging to see that this is finally taken shape after all these years. So I was gonna go into like the key features of the limited partnership fund. But before that, one of my next slide was actually to just describe what a typical offshore fund structure is. But as Tina alluded to earlier, I think a lot of the family office, the first generation family office in this part of the world, they are very used to using the SPC structure. And I think because of that, the Singapore VCC structure, which has just started about this year, has also gained a lot of that traction. A lot of the family offices started looking at the VCC structure. To my mind, when we act for family offices, what are their concerns? So we tell them, the typical structure in the private fund space, in the private equity space, is a limited partnership structure for various reasons, which I'll go into and which Anson touched on earlier. Things like tax transparency, freedom of contract, and investor familiarity. And investor familiarity and also the investee company familiarity. So there's tax and legal certainty around how these structures work. But a lot of family office just comes to us and say, well, I know we don't really care about this. We just have like a rich uncle or rich auntie. But we're not going to look for institutional money. We're not going to look for very sophisticated investors. And a lot of people just don't know what a limited partnership is, but everyone knows what a company is. So I think everyone just tended towards like a company structure. And then if you want to set up different pools of cash to invest into different things, if you tell them, if you use a limited partnership structure, you tell them, every time you do one, you need to set up a different limited partnership. As opposed to SPC, where you just have one company and have different SPs. So obviously the SPC model suddenly looks so much more attractive, especially because the cost of setting up an offshore a limited partnership structure is just so prohibitive. Every time you have to set up a GP and an LP and a GP and an LP and a GP and LP, every time you want to have a new investment strategy, a new mandate. So I think that's why a lot of people just tended towards the SPC structure for family offices, because it just seems, it's a company, so everyone kind of knows what a company is, everyone knows what a shareholder is. Not many people know what a limited partner is, for instance, but a bit foreign, that concept. And also because it's fundamentally cheaper. You just set up one company and then you have multiple SPs. But as Ray also alluded to earlier in his talk, he said 69% of family offices are obviously mature. Family offices are maturing, and 69% of them are trending towards private equity space. So I think as investors and family offices get more and more mature and more and more sophisticated, I think it only makes sense to start future-proofing your structure. Future-proofing. It might work now, but will it work in 5 years' time? Will it work in 10 years' time? You wanna create a structure that makes sense for now and the future. So that's why we usually advise clients, like if you can afford it, and go look towards the limited partnership structure. So anyway, I'll go on to the limited partnership structure next. So just noting that a large part of the audience here probably aren't that familiar with this structure, so I'll just very quickly go through this. So on the right-hand side, at that triangle, you see that's the limited partnership. So that's the pooling vehicle. That would be akin to a company, I guess. So, your investors are the limited partners. They will invest, the limited partners on the top right, they will invest into that limited partnership structure. Every limited partnership has to have a general partner by law. So that will be the red box on the left-hand side, and then and that is usually just a shell company in the Caymans, and that would then have an investment management agreement with the investment manager, which is onshore in Hong Kong or an onshore jurisdiction somewhere. And I guess you think of it this way, where the investment manager is basically the entity with an office, with staff, with analysts, with associates, with the founder. This is the real office. This is where real people sit in IFC or somewhere, and it's probably licensed. And then you have the other service providers. So this is what a typical fund structure would look like. It's basically the same structure you would see in Cayman, in BVI, in Guernsey, Jersey, that we would see for private equity, private funds, private equity funds. So now if I move on to the next slide, this is the Hong Kong limited partnership fund structure. So as you will see, it's actually exactly the same. But except that there is one layer less, which is there is just no Cayman anymore. So there's just one jurisdiction. So as Anson mentioned earlier, this is obviously very, very intentional. We have been really involved in the drafting of the bill, and during the consultation with the MTSB last year, one of the points that the industry wanted was that they didn't want the LPF to look weird or look strange. They wanted it to look exactly the same as the current funds that they were doing. And this is intentional to make it frictionless, to remove the barriers of entry of people who want to use and market the LPF and people who want to invest into the LPF. So I guess my one statement here, one thing here, which one takeaway for you, if there's anything that you have to remember from this is the structure is exactly the same. Like the structure, the feel of the structure, it looks exactly the same. In fact, we're doing documentation now for clients who have asked us to set up funds for them. The documentation is the same. So it's from that part of it, you as an investor, you as a fund manager should not have any worry that it's going to be weird or I have to relearn something. No, it's the same. So it's going into detail now of limited partnership fund. So like I mentioned earlier, it has to be one general partner, at least one limited partner. You have to have this document called partnership agreement, which is very much like a shareholders agreement. You have to register it as a limited partnership fund, and you have to have a registered office in Hong Kong. A definition of fund. So a definition of fund, I think most funds that you are currently investing in or currently managing would fall within this, which is, the operating persons have to manage the assets of the fund on behalf of participating persons. So it's with an objective to derive profits and gains. So I think this would probably not be a hurdle to most of you. So the key features of a limited partnership fund, unlike a company or unlike a SPC, there's no separate legal personality. So the partnership itself doesn't exist as an entity. This means that there's also tax transparent. So unlike a company which pays tax upon any receipts, this is completely tax transparent. I think the points to note here is there's a freedom to conclude contracts. So which means that you can basically negotiate and write whatever you want into the partnership agreement, so long as your partners all agree to it. In that sense, you're not bound by company law. You're not bound by the constraints of shares and shareholdings. You're not restrained by having you have to have profits before you can do distributions. There's none of these restrictions basically. So LPF also doesn't require any SFC authorization, and there's no investment restriction. You can invest in anything that you want. So as you can see, it's actually very, very business friendly. Now, I'm conscious of the limitation on time, so I'll very quickly zip through some of these. GP can be a Hong Kong company. It can be an individual over 18 years old. A GP, for those that you don't know, it has unlimited liability. So ordinarily, the GP is usually a shell company. We wouldn't use a SFE licensed manager with overheads and staff to be the general partner, purely because that's just exposed to too much liability. A limited partner are basically your investors. So in a family context, those will be the family members. As mentioned previously, a limited partner loses his limited liability. So basically, it has unlimited liability once it goes into management. But as you can see, there are safe harbor provisions in the ordinance, which allows it to do pretty much almost the same as management, basically. So anything that all the consents that is required, a power to appoint a board of directors. So it's got quite broad pseudo management abilities here. The establishment process is super simple. So we've actually established already 6. So our CorpSec is completely on board on how to set up this process. So we've really done 6 limited partnership funds. We've registered them for our clients. So it's definitely we're definitely getting quite a lot of inquiries on this. So this is just sets out what the establishment process is. So I think one main point, I'm conscious of the limitation of time. So why not stick with the SPC? Besides the future proofing point that I mentioned earlier, that we should probably start looking into the limited partnership vehicle. The other point is, if you are in an offshore jurisdiction, yes, it might be cheap now. Yes, there might be low level regulations and regulatory oversight, but all this will change. All this, and it is already changing because of the OECD's measures. So as you can see over time, since December of 2018, June 2019, up to July of this year, there has been quite a lot of increased compliance requirements in the Cayman Islands, from registration to having to put more substance in the ground in the Caymans. So there is increasing costs, and this will probably only increase over time. And also, I think fundamentally, at the end of the day, why have, if you're based in Asia, why have a structure that is based in Caymans? Having administrators dealing in Caymans, being in a different time zone. Why not be in the same part of the world, doing the same thing, and be cheaper? These are some basic information on the comparison, which a comparison of the basic information. So again, just to point out that it's fundamentally the same. But I guess another cost saving is you don't need 2 levels of counsel. You don't need offshore counsel anymore. You just need to rely on one set of counsel. So conscious of time. So one other point to note is custodian is not mandatory, whereas in the Cayman Islands it is mandatory. Valuation, again, in Hong Kong, nothing specific there. It's not required by law. Filings are pretty much the same. AML is pretty similar as well. What I want to get onto is basically this slide. Okay, so this was a slide that I was going to basically try and end on. You can see that it's just exponentially cheaper. If you look at the total, the annual filing fees, for instance. Someone did ask whether or not there was a typo. We had the decimal place in the wrong place, but no, the annual filing fee is like $13 per year, which is, if you see a lifetime of a fund, let's say 10 years, it is quite a lot, right, over time. The registration fee, for instance, we don't have any of that. And the setup costs are fundamentally much cheaper. So I guess that one hurdle that I mentioned earlier, that of family officers not setting up funds and limited partnerships because it's expensive, that's not relevant anymore. And again, that's on this part of the world, time zone, better for you. It's cheaper, it's more flexible, not constrained by corporate law, freedom of contract. I find it pretty much a no-brainer why you wouldn't choose Hong Kong as a jurisdiction. And I think a real life example is we just had an inquiry just yesterday of a real estate fund, and they were basically saying, yeah, I don't see a need to set up in Caymans anymore. Let's just set up in Hong Kong. And they are investors. They had a chat with their investors, and investors were absolutely fine. And investors were quite happy actually, because now they know they're in an onshore jurisdiction. It's SSC regulation in this part of the world. So they definitely were more comforted in that regard. So just to sum up, again, investor perception about the onshoreization, which Anson mentioned earlier, Cayman no longer, once you come onshore, you're no longer in a perceived tax haven. I think bank accounts is an important point to note, because I think it's increasingly getting quite difficult to set up bank accounts for Cayman entities, especially for SPCs, because we were doing one deal for another family office, and they were having quite a lot of trouble with certain banks in relation to setup of SPCs, especially in relation to the concept of the SPs. Like the bank in question, they just couldn't wrap their head around this concept of SPs. There's clear tax policy, just as Anson mentioned earlier as well. There's very, very attractive double taxation treaties. Costs is something that I've stressed and harped on quite a lot. Regulatory certainty, and no onerous compliance obligations, and like in the Caymans. And on that note, I'll end here and hand it back to Tina.
Thank you very much, Gordon. So to sum up, or really as Gordon and Anson and even Ray mentioned, I'm also we are multi-family office. We're helping our clients to set up different fund structure and exploring the Hong Kong new limited partnership fund as well. So I've been talking to lawyers and different professional parties every day. So I'm actually a user of these funds, and I do want to touch on a few points before I show the graphic of our live case for discussion. I think a few points that I want to mention is about the registration part. I think is very simple. And if I were really to compare, let's say to register a Singapore, because when people are concerned about tax, right, tax-free, what does it mean? How do I have to apply for the taxation part? I think from my experience, Singapore BCC, I do have to apply and wait for the approval. But for Hong Kong, it's as simple as just, maybe Anson, you can.
Yeah, sure. So for Hong Kong, the tax exemption is largely in line with how we do it in terms of the broad tax framework. So you do not need to go to any authority, any tax authority or other, like us or SFU, you do not need to go. All you need to do is make sure that you comply with the relevant legislation requirements, and then you're good to go. So it's rather simple. It's kind of a self-honor system. But of course, if at the end of the day, under the ordinance, the Inland Revenue Department would have the right under the law to really to open your books. But this, I would say, it does not happen, often. It's really when things really go wrong, right? So,
Understood. And also a few points that I will just pull out the graph real quick to show the case study that we have. A lot of times, people would ask us in what situation that we would need to, I'll just get the mouse back. In what situation there will be a licensed entity will be involved, because quite a lot of family office that, they want to set up a fund themselves, but they keep questioning, do I have to engage Raffles? Do I need to be a licensed entity to set up such fund? So maybe later on, Guosen can touch on it as well. So, going back a little bit, just to backtrack, as a Raffles Family Office, we do see several key components that, when they come to us, when they face complex challenges, including, setting up a family governance, between the family members, first gen, second gen, wealth transfer, they need a proper framework. Fund structure could be, a useful tool. And then when it comes to, after setting this fund, we need, professional like Raffles to manage their assets, investments, advice, and execution. So this graph would give our audience a picture of what we are doing right now, what we do, what do we usually propose to our clients, and Ray can maybe just give an overview of this, and I'll throw a few questions after on.
Yeah, thanks. I mean, from Gauss and Anson, thank you very much for sharing. And from Gauss, you mentioned about the hurdle or the entry, the barrier before. I mean, it's simply as said that I think it's why not we don't do that. I mean. There's no reason why now, because I mean, for Hong Kong fund, it's as simple as you just put it into different LPF 1, 2, 3, and as we discussed earlier before that, we can even put in the liquid asset like secondary market asset into that for management. So in our point of view, it's for all the single family office structure right now, we see most of it in Asia. They're trying to we copy what has been successful in the more developed countries. But for that kind of structure, that I do see a lot of potential for especially for private investment, or of course for the offshore investment as well. And so I mean, if you guys could stand from our point of view, right? So how do you guys see that LPF structure? If we put it into places.
So maybe I'll just quickly summarize my view. So I mean, the family trust is on top. I mean, that would basically be the family, the family members will assume invest directly into that. So we will basically set up different LPFs to invest in the different asset classes. I think one of the issues previously, especially if you use like a single company or even an SPC, like there was always a query on the segregation of liability, whether or not it would be respected in different jurisdictions, especially if you use a segregated portfolio. But you would know for certain that if you do set up different LPFs like that, there's definite segregation of liability between your assets, which means if, for example, if your private investments or your creator and the creditors come off the LPF, it's segregated there. It's not going to affect the 2 or 3, basically your assets in 2 or 3. So creditors against LPF 1 can't come off the LPF 2 and 3. And I guess the next point to state is also a freedom of contract. So if for example, if LPF 1 does really well and the family trust says, oh, I want to let my friends and family in, my other friends and family, maybe not part of the family, they can just come in through the LPF 1 directly. And because it's a limited partnership, like you can just contract whatever you want basically in that document. It's just a purely contractual arrangement. It's so much easier. Don't have to issue shares or anything. So I think in that regard, it's much simpler. And then to Tina's point earlier, Do people need to be licensed to manage this? I think what we'll tell people now is yes. I think if you basically fall within one of the regulated activities, then yes, you do need to be licensed. And I feel like if you are going to be managing, security, advising on securities and managing assets, you probably would fall within one of those categories, unless you can find an exemption somewhere, which is quite grey and quite limited, the exemptions. So we always tell people to err on the safe side. I think SFC is also, maybe I don't know if you can comment it, but I know SFC is also becoming more diligent in looking in this area. So I think it's probably better to err on the safe side.
Right. So I just supplement one point. I completely agree with what Doss has said. In terms of the investable universe for LPF, both in terms of legal structure, what they allow, and both in terms of the tax exemption that we put together. And when we're building these, what we had in mind was to make it as flexible as possible. So if for a structure like this, we have LPF1, that can be, for illiquid strategies, maybe in PE, and LPF2 that can be in more venture capital type of investment. LPF3 maybe in a separate portfolio, maybe a liquid portfolio, and we make it so flexible that we do not impose any restriction on investment holding under the LPF. And we have actually been talking to a number of other parties when we do our outreach. A number of them are actually exploring using this vehicle for the liquid investment strategy. And this, to be honest with you, it was not on day one. It's not part of our design, but we made it so flexible that now when we review, we see that it's compatible. So it can be used for different portfolio investments.
Yeah. I mean, and on the other hand, I think Gauss has mentioned as well about the account opening. So we as a family office or even asset managers, that we do see problem with opening Cayman fund account.
Yes.
Then I guess Hong Kong LPF would be probably most benefit from that as well.
Yes,
definitely.
Yeah. And I guess one point to add about you. So on the far right of the chart, you say investment governance, setting up investment committees for LPF. Yes, you can have the family members, set up investment committees on the LPFs.
Yes, I totally agree. That would be like when you mentioned freedom contract, I think this would apply to some family office when the father, they would like to still be in control in certain strategy, but at the same time they can have a separate LPF to let their next generation or let friends to basically do co-investment with them. And the trend is doing the club deals, right? Maybe their friends can be in charge of some strategy and so and so. But all of these are basically segregated, right?
And globally, we're actually seeing from my experience with Exchange Fund globally, we're seeing that investors, especially the more established, more mature institutional ones, they are increasingly allocating more of their portfolio into illiquid assets, PE type and fund type, real estate type of assets. So this would, as Scott said, would cater for the future trend. And just one more point to supplement on the account opening discussion. So as we, HKMA being the bank regulator, so we did talk to a number of banks in terms of, when we pushed this LPF regime. And what I wanted to do is that, when this goes out, we won't, let any of the users face the same problem otherwise if they use an offshore vehicle. So a number, and I was very delighted that some banks have actually set up a new team targeting these, PEVZ and LPF users. So that's also good news to share.
Okay. Because of the time constraint, I do have some questions. I think I will only be able to touch on one or two, but a lot of them again I will be gathering the answers from the professional party, from Ensign, from Gauss, and then, reply each of you from the email. But then some of the questions that I see is like, can LPF be used by, foreign fund manager, or will you need to be licensed in Hong Kong? I think we briefly touched on that, right? You need to be a licensed entity in Hong Kong if you're falling under the regulated activities, right? Correct. Okay. And hold on, and just a few questions that, given this new platform introduced in Hong Kong, what are the differences for a fund for now to consider set up in Hong Kong versus Singapore? Anyone want to touch on that? Just a very quick I think it
Well,
depends,
maybe,
right?
Yeah, maybe
It's-
I'll attempt this.
Yep.
So when we consider setting up fund operation, we look at one side of the equation. We look at what they offer in the fund artillery. So we now have LPF, we have other vehicles in Hong Kong. But more importantly, I would say, is in terms of operation. Look at the people we have. We have good tax advisors in town. We have good family office operators in town. We have the best people. And from time to time, when we do outreach, we talk to investors in Europe, in the US. They already know that our ecosystem in Hong Kong is very deep. It's deep pool of talents we're talking about. It's a robust, good, well-regulated banking sector. We have is a robust IPO market. So in the past 10 years, we have got 6 out of 10 times being the world's champion in terms of amount of capital raised. So with all these, when we're talking about investment opportunities, then you can imagine we offer the best amongst Asia peers, and that's why. So apart from fund, fund vehicle is one thing, but the more important thing is the ecosystem that we offer. And with that, I'll let you decide in terms of how you want to operate and what are your concerns, what markets you're looking at also matters.
Mm-hmm. You touched on a very good point, and by the way, we're Hong Kong and Singapore licensed, so feel free to come to us and we can further explore some cases. And just a very last question, because I'm sorry to keep you guys here. I think this is a very good one, and it could be let me know. So because having one of the key benefits of the limited partnership fund introduction is the maintenance of investor confidentiality and privacy. And then actually from our side, some of the investor, they would ask, in the context of the introduction of the new Hong Kong security law, will it be affected in terms of investors' privacy or confidentiality? I think this will be a last question that we will be touching on. Let's see who will be.
When we design this regime, one of the utmost important, guiding principle is to preserve, amongst those I talk about in family, market friendliness, etc. One of the most important principle that we had in mind was to protect investors' confidentiality. So we will see in our design, we don't even collect any of those investor information. When you register with the CR, all you need to provide is the name of GP, name of fund, who's going to be the investment manager. We don't ask who the investors are. Number of investors, we don't know. Who they are, we don't know. We only require that you do your AML diligence and to keep all your work in your office space, right? In the GP's registered office. So that's all.
Okay.
We are very vigilant.
That is very good too, and clear for us to know. And of course, from our side, as a license manager, we need to do the KYC and need to know the UBO as well, right? So again, thank you very much. I wish we could have more time, but thanks for attending the webinar. I do want to aim to do a Chinese version one later on with the handsome gentleman here. And again, we will be sending out some materials after the webinar. And thank you again for your time, and thank you. And I hope you guys have something to take away. Thanks.